One of the most dangerous myths for digital nomads is that forming a US LLC solves your tax problems. For entrepreneurs, this belief is not just wrong, it is a financial trap that can trigger penalties far exceeding any potential tax savings. If you opened a US LLC because someone promised 0% tax while you travel, you are the person I am talking to. Whether you are a US citizen abroad or a foreign founder billing clients through a US company, the IRS has specific rules for your situation. The confusion stems from a misunderstanding of how the United States views jurisdiction. Unlike most countries, the US does not care where you sleep at night. It cares who you are on paper and where your income is sourced. If you get this wrong, there are only two outcomes: unexpected double taxation or serious banking and compliance problems. In this video, you will see when a US LLC can lead to low or even zero US tax, and when the same structure becomes a ticking time bomb. For the US citizen digital nomad, the reality is strict. You cannot simply leave the country and stop paying the IRS. Your LLC is a pass-through entity, meaning the income flows to you, and your tax liability follows your passport, not your location. Many people believe the foreign earned income exclusion is a magic wand that wipes out all taxes. It is not. It has ceilings, strict time tests, and it does not eliminate the self-employment tax that funds Social Security and Medicare. There's another layer most US nomads ignore until it is too late. High-tax states such as California or New York may still treat you as a resident even after you leave. If you do not clearly break residency with those states, they can tax your global LLC income as if you never left. Selling or renting out your home, changing your driver's license, and cutting local ties are not cosmetic details. They are part of your tax defense file. For the US nomad, the physical presence test is your primary battleground. To qualify for foreign income exclusions, you must be outside the US for 330 full days in a consecutive 12-month period. One miscalculation, one emergency trip home that lasts too long, and you fail the test. If you fail, your entire year's income can become fully taxable at US rates, retroactive to day one. Your LLC offers no protection here. It is transparent to the tax authorities. Now, if you are a non-US founder, pay close attention. This is where the zero tax strategy lives or dies. The US wants to tax you if you have a substantial presence, use dependent agents, or have income effectively connected with a US trade or business. If you run a service business, consulting, marketing, coding, and you perform all that work from outside the US with no employees or dedicated office in the US, your income is generally not taxed by the US under the service source rules. However, selling physical goods changes the equation entirely. If your LLC buys inventory and ships it from a US warehouse to US customers, that income is generally treated as effectively connected with a US trade or business. You owe US tax on that profit. The mistake many foreign entrepreneurs make is assuming that because they do not live in the US, their dropshipping or Amazon FBA business is tax exempt. It is not. Inventory sitting on US soil creates a taxable nexus for your LLC. There is another risk for foreign owners that is often overlooked called the dependent agent rule. If you are a foreign owner but hire someone based in the US who regularly negotiates and closes deals for your LLC, the IRS can treat their presence as your presence. At that point, your supposedly remote structure starts to look like a US business, and you can be exposed to back taxes and penalties even if you never entered the country. The most severe penalty for foreign-owned LLCs has nothing to do with owing money on profit. It is about reporting information. Even if you owe zero tax, you may be required to file Form 5472 with a simple shell return. That form discloses the foreign ownership of the US entity and related party transactions. The penalty for failing to file or filing late is $25,000 per year. Many foreigners open LLCs, ignore the paperwork because they believe their tax owed is zero, and wake up to a massive debt. Banking is the second pillar of this structure, and it is where many digital nomads get burned. US banks and fintech platforms are under pressure to prevent money laundering and sanctions violations. They are shutting down accounts that appear to be shell companies. If your LLC has only a registered agent address in Delaware or Wyoming, all logins come from overseas, and you have no real business operations, you are flagged. You must maintain a paper trail, operating agreements, clear invoices, and a functional business website that matches your application details. If you are a digital nomad, this is where it hits you hardest. The disconnect between your tax residency and your banking setup. Banks often ask for a utility bill to prove your physical address. If you provide a fake address or a mail forwarding service that is blocklisted, your funds can be frozen with little warning. You need to use a distinct, verifiable address for your banking profile, often separate from your registered agent address. Transparency and consistency across documents reduce the risk of sudden account closures. Let's talk about the specific trap of disregarded entities. A single-member LLC is disregarded for income tax purposes. For a U.S. person, this means the activity flows onto your personal return. For a foreign person, this means the entity effectively does not exist for tax purposes, but it does exist for reporting purposes. This duality confuses almost everyone. You are a corporation for liability, a ghost for income tax calculation, but a highly scrutinized entity for information reporting and compliance penalties. So, how do you navigate this without hiring a team of lawyers? First, execute a residency diagnostic. If you are a U.S. citizen, you must prove you are a bona fide resident of another country or meet the physical presence test, and you must document your break from high-tax states. If you are a foreign owner, you must show your tax home is outside the U.S. and that you have no dependent agents or physical inventory on U.S. soil. Record this status in your internal documentation and keep supporting evidence. Second, separate your income streams. If you have a U.S. LLC that sells both services and goods, you are mixing potentially tax-free income with taxable income. This taints the entire pool. It is often cleaner to have two separate structures. One entity for the service business that remains outside U.S. tax for the foreign owner, and a separate U.S. corporation or LLC taxed as a corporation for the physical goods business that pays its fair share of U.S. tax. Clear separation makes your story easier to defend. Third, rigorously manage your 1099-K and information filings. If you receive a 1099-K from Stripe or PayPal, the IRS has a copy. If they do not see a tax return or an information return that reconciles that amount, their automated underreporter program will flag you. For foreign owners, ensure your accountant files the required foreign ownership forms by the correct deadline every single year. Do not ignore these forms just because you believe your tax owed is zero. In this area, paperwork is the tax. Finally, do not treat your LLC as a static object. Tax treaties change. Banking regulations tighten. What worked for a digital nomad in 2021 may be a compliance failure in 2025. Review your structure annually. Check whether your state of formation has raised franchise taxes or whether your home country has signed new information sharing agreements with the U.S. Your structure requires maintenance, just like your business needs sales and marketing, and ignoring it is what turns a tool into a trap. By understanding the distinction between U.S. persons and non-resident owners, and respecting the difference between taxable income and reportable events, you protect your capital. You avoid the letters that freeze assets and the quiet penalties that destroy cash flow. Use this as general education, not individual legal or tax advice. Your specific situation may require a professional who can review your facts in detail. If you are running or planning to run a U.S. LLC from abroad and want low friction without stepping on a regulatory landmine, this breakdown is one you cannot afford to ignore. Subscribe to the channel, turn on notifications, and hit like so this content reaches more founders and nomads who are one bad assumption away from an expensive lesson. If you have a specific question about your structure, drop it in the comments. I use those questions to decide what to unpack in the next videos.